Let's look at the second part in detail now. The comparison. When we say comparison, what are we trying to do? We are comparing year-on-year change in one of the categories here. So for example, I'll look at the equity for last year and I'll compare that with the equity for this year, which may have either gone up, which is increased, or it may have gone down, which is reduced. So what does this tell me? If the equity has gone up, we'll try to find out the reasons for this, which may be a new issue of equity by the company, which may be additional profits earned during this year by the company, and so on. When you look at reduction of equity, it may be on account of several reasons. The company may have bought back its own shares, or the company may have lost some money in the business during this year, or the company may have made the money, however it may have distributed the money or distributed the profits to its shareholders during this year. So these could be the reasons for changes in equity during a particular year. Like this, we will be comparing the year-on-year numbers for all of these categories and their subcategories in this case. So we will be looking at the opening balance sheet and the closing balance sheet and then try to find out what has been the change in fixed assets. If the fixed assets have gone up, that means the company has done capital expenditure during that year. If they have gone up substantially, for example, at the beginning you just have 10 lakhs rupees of fixed assets, and in the year-end balance sheet you have almost a 10 crore type of a number which is seen in the fixed assets. That means the company has done substantial capital expenditure during the year. You will also compare the opening debt as well as the closing debt number. Again, check if it has gone up, that means the company has taken a loan during the year, and where has it taken it from? Is there any term sheet which is available for this kind of a loan? Similarly, you will try to do this for current assets and current liabilities. So when we say changes in current assets, we'll try to find out the changes in each of those items. So if the inventory at the beginning of the year is substantially lesser than the inventory at the end of the year, that means the company has accumulated significant inventory during the year. Same is the case applicable to receivables or even cash in bank. So what we are trying to do is we are comparing the opening and closing numbers for different categories of assets and liabilities, and then try to find out the reasons for the same.